Welcome to the latest edition of Fundamentals. This time around, I'm going to look at one actively managed member of our list of 72 favourite funds, namely River and Mercantile UK Equity Smaller Companies. The £850 million fund's mandate is to generate capital growth for investors and, as its name rather suggests, it seeks to do that by investing in smaller companies. Fund manager Philip Rodrigues and team focus on making their picks from the smallest 10% of the UK stock market as measured by their market cap. That's a limit of around £1.6 billion at the moment. The fund comes with a very clearly defined investment process which is underpinned by a quantitatively based proprietary system which provides numerical filters and screens to help the fund managers sift for suitable portfolio picks. In general, Rodrigues and team like to identify young, rapidly growing businesses that can deliver hefty share price advances. So if income's your game, this might not be one for you as the near 1% yield suggests. The portfolio's kept pretty tight. The latest fact sheet revealed it contains 71 holdings, although the top 10 represent barely a quarter of the assets. So the River and Mercantile team does look to provide diversification to manage the risks that can and do come with smaller firms. The biggest positions in the fund as I sit here are premium drinks mixer provider Fevertree, drinks retailer Conviviality, smart metering systems, corporate telecoms and bandwidth provider Gamma, and language translation software provider SDL. By market cap, just over 20% of the assets are in mid caps, nearly 60% in small caps, and just over 20% in micro caps. There is no exposure at all to large caps such as the members of the FTSE 100. By sector, industrials, consumer discretionary and technology are the three biggest sector exposures at 26, 21 and 15% of the portfolio respectively. Intriguingly, just 8% of the assets are in mining stocks and barely 3% in oils, despite the huge number of junior diggers and drillers quoted in London. Anyone looking for defensive stodge might be disappointed as well, with a zero weighting in utilities, 3% in telecoms and just 4% in healthcare. The fund's eligible for SIPs, ISAs and dealing accounts, and the minimum investment is just one share. On this occasion, we're talking about the accumulation units, where the dividends are automatically reinvested for you, although River and Mercantile UK Equity Smaller Companies does also come with income units, where dividends are paid out semi-annually. The ongoing charge figure is 0.83%, so you do have to pay for the expertise of the fund managers, and for those who set store by such things, the fund comes with a 5-star ranking from Morningstar. So, those are the mechanics. The question to address next is why could investors consider this fund for portfolio inclusion today? And I think there may be 3 possible reasons. First, small caps have done pretty well in the UK this year. The FTSE AIM All Share Index has outperformed the large cap FTSE 100 and the mid cap FTSE 250 with an 18% gain against 2% and 8% respectively, while the FTSE small cap benchmark's up 10% in capital terms. Small caps can provide terrific share price gains when things go well and you find a few winners. Second, picking small caps can be rewarding, but it can be downright dangerous too. Small caps tend to be more reliant than big ones on a particular executive, a certain product or a key geographic market, so they have less margin for error if something goes wrong. In addition, they're not always as well funded as big caps, so in a worst case they can turn into a cash sink or even go broke. A fund with 71 holdings therefore provides some welcome diversification, a bit of a spread, and some management of the downside risks. Finally, the fund and its managers have an excellent long-term performance record to suggest that its screening process is proven. This chart shows how it's done since inception in 2006, although I should stress that Philip Rodrigues himself has not been there for all of that span. He joined in 2014. This is not to say that River and Mercantile UK Equity Smaller Companies Fund will suit every investor or their needs for 3 reasons as well. First, income investors are unlikely to be excited by the 1% yield. Second, others may not like the 0.83% ongoing charge figure. Now, there are only a handful of rival actively managed small cap funds that come cheaper, although the sole passive exchange traded fund is cheaper too at 0.58%. But I've no doubt that the River and Mercantile team would argue they provided value for money given their 5 and 10 year performance records in particular. And finally, small caps are risky. Things can and do go wrong. Small caps tend to outperform when markets are rising and animal spirits are high, but they can underperform and get hit hard when a bear market growls its way into view and investors start to run scared. So, you need to make sure that you can be patient and sit out any bear downturn that may come and not find that your personal circumstances mean you are forced to cash in the fund at a potentially inopportune time. Investors must therefore do their research on River and Mercantile UK equity smaller companies to make sure that it fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work or indeed at risk. So thank you for watching, and I look forward to seeing you next time.